In the hushed corridors of the US Treasury Department, where analysts pore over bid sheets and yield curves under the weight of trillions in national obligations, a moment of profound unease gripped the markets on December 11, 2025. The auction for $39 billion in 30-year Treasury bonds, a routine event in the world's largest debt market, concluded with demand so anemic that the Treasury accepted yields far higher than anticipated to sell the full amount, a development immediately labeled as a spectacular failure by observers. Foreign participation, historically a pillar of support, collapsed dramatically, with reports confirming that Japan, the largest foreign holder of U.S. debt, and China, the second largest, submitted no meaningful bids, effectively refusing to purchase any bonds at the prevailing rates. Yields on the 30-year bond spiked to over 5%, the highest since the early 2000s, triggering a sharp sell-off across equity markets and forcing emergency interventions from the Federal Reserve to stabilize funding conditions. This was not a minor hiccup, but a terrifying signal of eroding confidence in America's ability to finance its deficits indefinitely, as two of its most reliable creditors stepped back, leaving the auction exposed and the broader financial system vulnerable to a cascade of higher borrowing costs and market turmoil. The end of easy foreign demand for U.S. debt had arrived, compelling a reckoning with the sustainability of America's fiscal path in an increasingly skeptical world. To fully comprehend the significance of this Treasury auction failure and the refusal of Japan and China to buy bonds, prompting Federal Reserve intervention, we must first examine the mechanics of U.S. government debt issuance and the historical role of foreign investors in sustaining it, concepts that form the backbone of America's economic power, but are increasingly tested by global shifts. The U.S. government, like any large entity, spends more than it collects in taxes most years, creating annual budget deficits that accumulate into the national debt. Over $35 trillion by late 2025, roughly 120% of GDP. To finance these deficits, the Treasury issues securities, short-term bills maturing in months, medium-term notes, and long-term bonds spanning 30 years. Explain auctions simply. The Treasury announces how much it needs to borrow, investors submit bids stating the yield they're willing to accept, and the auction clears at the highest yield that sells the full amount. Strong demand means low yields, cheap borrowing for the government. Weak demand forces higher yields to attract buyers, raising costs. Foreign investors have been crucial to this process. Japan and China, holding over $2 trillion combined in U.S. Treasuries as of early 2025, provide steady demand. Japan for safe returns on its vast savings, China to manage trade surpluses and stabilize the yuan. This foreign appetite kept yields low, allowing America to borrow cheaply despite deficits averaging $2 trillion annually in recent years. The dollar's reserve status, used for 60% of global reserves and most trade, reinforced this cycle, creating what economists call exorbitant privilege. The U.S. could deficit spend with minimal immediate consequences. The step-by-step build-up to the December 2025 failure reflected mounting pressures on the system. U.S. deficits swelled in the mid-2020s from infrastructure spending, military commitments, and entitlement growth amid aging demographics. Foreign holdings peaked in 2022, but began declining as alternatives emerged. China's yuan internationalization and Europe's green bonds offered competition. Japan, facing its own debt exceeding 250% of GDP and ending ultra-low rates in 2024, repatriated capital for domestic needs. China accelerated diversification post-2022 Russia sanctions, selling hundreds of billions in treasuries to buy gold and fund Belt and Road. Auctions showed strain earlier in 2025. Weak demand in spring and summer pushed yields up gradually. November saw indirect bids, often foreign central banks, drop sharply. The December 11 auction crystallized the trend. Bid-to-cover ratio fell to historic lows, yields jumped 50 basis points in days, forcing the Fed to announce emergency Treasury purchases, quantitative easing revival, to cap rates and restore liquidity. Hidden or less discussed factors explain the timing and severity. First, coordinated signaling. Japan and China, facing U.S. tariffs and tech restrictions, used abstention as leverage without overt dumping, avoiding market panic while pressuring policy. Second, domestic imperatives. Japan's rate normalization made home bonds attractive. China's growth slowdown prioritized internal stimulus. Less visible is the role of private investors. Japanese insurers facing unrealized losses on foreign holdings from $we. Agnes reduced exposure quietly. The Fed's intervention, buying hundreds of billions in bonds, stabilized markets short-term but signaled deeper issues. Reliance on central bank support risks inflation if prolonged. Global implications are far-reaching. Higher U.S. rates slow growth, raise mortgage and corporate costs, potentially tipping recession. Dollar weakness boosts exports but imports inflation. Foreign holders face losses on existing bonds, accelerating diversification and fragmenting reserves. Emerging markets suffer capital outflows as rates rise. In conclusion, the 2025 Treasury auction failure, with Japan and China refusing bonds, forcing Fed intervention, marks a turning point in U.S. financial dominance. This event, rooted in fiscal overreach and global realignment, demands reflection on sustainable borrowing. As intervention buys time, true resolution lies in discipline and diplomacy, ensuring America's debt serves strength, not vulnerability, in a changing world. To expand on the historical context, the U.S. dollar's rise as the world's reserve currency was not inevitable, but a product of specific geopolitical and economic circumstances. After World War II, Europe and Asia lay in ruins, while the U.S. emerged as the sole superpower with an intact industrial base and massive gold reserves. The Bretton Woods system formalized this advantage, pegging other currencies to the dollar and the dollar to gold, creating a stable framework for international trade and investment. This system facilitated the reconstruction of war-torn economies through American aid like the Marshall Plan, which pumped billions into Europe, fostering alliances and opening markets for U.S. goods. The 1971 Nixon shock, ending gold convertibility, could have undermined confidence, but the dollar's utility in oil trade, the petrodollar recycle, preserved its status. OPEC nations, flush with dollars from oil sales, reinvested in U.S. assets, creating a virtuous cycle. The 1980s Reagan era saw massive deficits financed by Japanese savings during their economic boom, setting a pattern of foreign funding for U.S. spending. By the 2000s, China's rise as exporter-in-chief accumulated dollar reserves, invested back into treasuries, keeping yields low and enabling U.S. consumption. This interdependence seemed stable until the 2008 financial crisis exposed risks. U.S. quantitative easing flooded markets with dollars, devaluing holdings and prompting diversification calls. The 2010s trade wars under Trump accelerated fractures. Tariffs on Chinese goods prompted Beijing to reduce treasury purchases, while Japan's BOJ policies kept yields low at home, reducing the appeal of U.S. bonds. The 2022 Russia sanctions, freezing $300 billion in reserves, were a watershed. Foreign governments saw the dollar as weaponized, eroding trust and catalyzing de-dollarization. Japan's decision in 2025 to abstain from auctions stems from internal shifts. The BOJ's 2024 exit from negative rates made JGBs attractive, yielding over 2% by late 2025. Japan's aging population demands stable returns for pensions, and dollar weakness from U.S. inflation erodes value. China, holding less but strategically, uses sales to fund domestic stimulus and yuan promotion, aligning with dual circulation policy, focusing on internal markets while selectively engaging abroad. The Fed's intervention in December 2025 involved immediate actions, expanding repo operations to provide liquidity, signaling rate cuts if needed, and coordinating with allies to support demand. Longer term, it revived QE, buying treasuries to cap yields, but this risks asset bubbles and currency devaluation. Global effects cascade. U.S. rate hikes slow worldwide growth as capital flows to America, weakening emerging currencies and raising debt burdens. Stock crashes wipe trillions, delaying investments in green tech and infrastructure. De-dollarization gains momentum. BRICS nations advance a common unit for trade, reducing dollar use. Socially, higher rates exacerbate inequality, borrowers struggle, savers benefit. Politically, U.S. fiscal debates intensify with calls for spending cuts. In conclusion, the 2025 auction failure signals a turning point. Japan's and China's refusal, forcing Fed intervention, highlights vulnerabilities in U.S. debt reliance. As the crash terrifies markets, the path forward demands reform to balance budgets, rebuild trust, and adapt to multipolarity. The dollar's era may wane, but wise navigation can ensure enduring stability in finances' evolving tapestry. As the financial turmoil sparked by the spectacular failure of the December 11, 2025, US Treasury auction and the refusal of Japan and China to purchase bonds extends into the spring and summer of 2026, the Federal Reserve's emergency intervention, initially hailed as a stabilizing force, evolves into a prolonged and controversial campaign of market support, one that raises fundamental questions about the sustainability of monetary policy in an era of fiscal strain and eroding foreign confidence. The Fed's actions, beginning with the announcement of open-ended Treasury purchases in late December 2025 to cap long-term yields, expand dramatically by March 2026 as successive auctions continue to falter. The central bank's balance sheet, already swollen from previous crises, surges past $15 trillion, with monthly purchases averaging $500 billion to absorb unsold debt and prevent a full-blown bond market rout. This revival of quantitative easing on an unprecedented scale succeeds in containing the immediate crash. 30-year yields stabilize around 5.5% by mid-2026, but at the cost of reigniting inflation fears and deepening divisions over the Fed's mandate in a politically charged environment. Step by step, the intervention's mechanics and consequences unfold with a mix of technical precision and unintended side effects that reshape the American economic landscape. The Fed's initial moves involve direct bidding at auctions through its system open market account, ensuring full subscription even as private demand wanes. By February 2026, forward guidance commits to whatever it takes yield control, echoing European central bank precedents but on a vastly larger scale. Repo operations expand to provide unlimited liquidity to primary dealers, preventing funding squeezes that could cascade into banking stress. These measures halt the terrifying crash. Equity markets, having lost 15% in the initial panic, recover half those losses by April as risk assets rebound on perceived backstops. Corporate bond spreads narrow, averting a credit crunch that threatened highly leveraged firms. Yet the intervention's persistence reveals deeper challenges. Inflation, subdued in early 2025, resurfaces above 4% by summer 2026 as dollar liquidity floods the system, weakening the currency further and importing price pressures through commodities. Wage price dynamics tighten in labor-scarce sectors, prompting the Fed to tolerate higher inflation temporarily to avoid recession, a stance criticized as abandoning its 2% target. Political backlash intensifies. Congressional hearings in May 2026 accuse the Fed of enabling fiscal irresponsibility, with proposals to audit or reform its independence gaining traction amid midterm election cycles. Less discussed amid the policy debates is the intergenerational transfer embedded in this prolonged intervention, a subtle but profound shift where future generations bear the costs of current stabilization. Higher inflation erodes real returns on savings, disproportionately affecting retirees and fixed-income households who relied on low-risk treasuries for security. Younger cohorts, already burdened by student debt and housing affordability challenges amplified by earlier rate spikes, face delayed wealth accumulation as asset bubbles reinflate under easy money. The Fed's balance sheet expansion, financed through money creation, effectively taxes future economic capacity through diluted purchasing power, a regressive mechanism that widens wealth gaps between asset owners and wage earners. Another underappreciated factor involves the global feedback loops that the intervention triggers, loops that paradoxically accelerate the very de-dollarization trends it seeks to mitigate. As the Fed prints dollars to buy bonds, the currency depreciates further, down 20% trade-weighted by late 2026, forcing foreign holders to confront ongoing losses on remaining treasuries. Japan, having abstained from new purchases, quietly trims existing positions through maturity rollovers, redirecting proceeds to domestic infrastructure and pension support. China accelerates yuan bond issuance for international investors, capturing flows from Middle Eastern sovereign funds seeking alternatives. The intervention's scale prompts emerging central banks to question dollar reserve safety, with collective holdings dipping below 55% of global totals by 2028, the lowest since the 1970s. Geopolitically, the prolonged crisis reshapes alliances and rivalries. U.S. adversaries portray the intervention as evidence of declining hegemony, bolstering narratives of multipolar finance. Allies express private concerns over dollar stability, prompting diversified reserve strategies that include euro, yen, and gold. Trade dynamics shift. A weaker dollar boosts U.S. exports but strains import-dependent partners, complicating supply chain realignments. By the late 2020s, the intervention's legacy crystallizes in a bifurcated U.S. economy. Asset markets thrive on liquidity, equities reach new highs by 2029, real estate rebounds in coastal centers, but Main Street growth lags, with small businesses facing credit constraints amid inflation vigilance. Fiscal politics polarize. Reform efforts yield partial entitlement adjustments and revenue measures, narrowing deficits to $1 trillion annually by 2032, but at political cost. Social fabrics adapt unevenly. Retirement security erodes for middle-class savers, prompting private annuity growth and delayed retirements. Education emphasizes financial literacy, with curricula incorporating debt dynamics and currency history. Cultural narratives reflect ambivalence. Optimism in technological resilience coexists with anxiety over systemic fragility. Global implications mature into structural change. De-dollarization plateaus as alternatives prove limited in scale, but the dollar's share stabilizes lower, with multipolar reserves reducing unilateral sanction efficacy. Innovation in finance booms. Tokenized assets and CBDCs offer new stores of value, while sustainable debt instruments gain traction. In the extended historical view, the 2025 auction failure and Fed's terrifying intervention mark a pivotal chapter in monetary evolution, from unlimited accommodation to constrained realism. The crash's terror, acute in its moment, catalyzes necessary recalibration. Fiscal prudence, diversified funding, institutional independence tempered by accountability. This era illuminates truths about debt in open economies. Foreign confidence is earned, not assumed. Central banks wield power but cannot defy fundamentals indefinitely, and crises, navigated wisely, forge resilience. As intervention tapers and markets mature, the legacy affirms adaptation's triumph. A U.S. economy leaner yet innovative, a financial system more balanced globally. In this rebalancing lies enduring strength for sustainable prosperity in a world where borrowing serves purpose, not postponement. As the prolonged Federal Reserve intervention in response to the 2025 Treasury auction failure extends through the late 2020s and into the 2030s, the initial terrifying crash gives way to a new era of managed high-interest borrowing, where the U.S. economy operates under the discipline of elevated yields that reshape investment, consumption, and policy priorities in ways that prove both constraining and clarifying. The Fed's open-ended Treasury purchases, peaking at over $1 trillion annually in 2027-2028, succeed in capping long-term yields around 5%, preventing a full-blown debt spiral, but at the cost of persistent inflation hovering between 3 and 4%, higher than the pre-crisis norm, but contained through careful calibration of asset sales and rate adjustments. By 2030, the central bank's balance sheet stabilizes at $18 trillion, a permanent expansion that becomes the new normal, with gradual runoff programs designed to normalize without shocking markets. Step by step, this high-yield environment restructures the American economy from the ground up, compelling a shift from debt-fueled consumption to investment-driven growth. Corporate capital allocation prioritizes return on equity over leverage. Share buybacks decline sharply after 2026, replaced by record research and development spending in strategic sectors, semiconductors, biotechnology, renewable energy, fueled by tax incentives and public-private partnerships under expanded industrial policy frameworks. Household behavior adapts similarly. Mortgage originations fall as 30-year rates settle above 6%, encouraging renting, multi-generational housing, and downsizing, while savings rates remain elevated at 12% of disposable income, channeling funds into productive assets rather than speculative real estate. Less discussed in economic retrospectives is the regional reconfiguration that higher borrowing costs catalyze, a realignment that accentuates America's geographic divides while fostering unexpected resilience in overlooked areas. Coastal financial centers, New York, San Francisco, thrive on high-value services and tech innovation, attracting global talent despite cost pressures. Midwestern and southern states, less burdened by housing bubbles, benefit from manufacturing resurgence. A weaker dollar and domestic focus drive onshoring in automotive, machinery, and defense, with states like Texas and Ohio seeing factory openings for the first time in decades. Rust Belt communities scarred by earlier deindustrialization find renewal through green manufacturing, battery plants, wind component facilities, supported by federal subsidies that survive fiscal tightening due to national security framing. Another underappreciated legacy involves the cultural and psychological maturation of American society under the weight of fiscal reality, a collective coming of age that reorients national priorities away from perpetual growth through borrowing towards sustainable prosperity. Public discourse, once dominated by debates over spending increases, shifts toward efficiency and intergenerational equity. Entitlement reforms, gradual retirement age adjustments, means-tested benefits, achieve bipartisan consensus by 2032, ensuring solvency. Without drastic cuts, education emphasizes practical skills, STEM enrollment surges, vocational programs revive with modern curricula in advanced manufacturing and digital trades. Cultural narratives celebrate self-reliance and innovation. Media portrays entrepreneurs solving real problems, while historical reflections frame the 2025 crisis as the Great Reckoning that averted deeper collapse. Geopolitically, the intervention's long shadow tempers U.S. ambitions while enhancing strategic focus. Military spending, constrained by higher debt service, interest payments exceeding $1 trillion annually by 2035, forces prioritization. Investments concentrate on high-impact technologies like hypersonics, cyber defense, and unmanned systems rather than expansive deployments. Alliances evolve toward burden sharing. European NATO members increase contributions. Indo-Pacific partners like Japan and Australia deepen joint production, reducing U.S. unilateral exposure. By the 2040s, quantitative legacies affirm the intervention's mixed but ultimately stabilizing impact. Debt-to-GDP ratios peak at 140% in the early 2030s, before declining to 110% through growth and discipline, a trajectory that restores market confidence without default fears. Inflation averages 3% over the period, higher than pre-crisis, but enabling real wage growth in tradable sectors. Productivity surges from technological adoption, with GDP per capita rising steadily despite slower population growth. Social metrics improve gradually. Life expectancy dipped briefly from crisis-related stress, rebounds through health investments. Inequality narrows as asset bubbles moderate and manufacturing jobs return with competitive wages. Civic engagement rises, voter turnout increases amid fiscal debates, fostering informed democracy. Global implications mature into a more balanced financial order. The dollar's reserve share stabilizes at 50%, with diversified holdings reducing volatility risks. Alternative systems, yuan zones in Asia, euro in Europe, coexist without dominance, facilitating trade while constraining unilateral sanctions. Innovation flourishes in distributed forms. Quantum and biotech breakthroughs shared through international consortia accelerate human progress. In the ultimate historical contemplation, the 2025 auction failure and prolonged Fed intervention stand as the defining financial crisis of the early 21st century. A terrifying crash that exposed excesses but catalyzed renewal. Japan's and China's refusal to buy bonds, rational in context, inadvertently aided global rebalancing by imposing discipline where markets had failed. This era illuminates enduring truths. Debt's privilege is conditional on credibility. Central banks can stabilize but not defy fundamentals indefinitely, and crises navigated with resolve forge stronger systems. As intervention tapers and confidence rebuilds, the legacy affirms adaptation's power. An America fiscally prudent yet innovative, a world financially diverse yet interconnected. In this rebalanced order lies sustained prosperity, for nations borrowing wisely, investors demanding accountability, and humanity advancing through shared lessons of restraint and renewal. As the mid-21st century unfolds, the legacy of the 2025 Treasury auction failure and the prolonged Federal Reserve intervention that followed crystallizes into a defining chapter of economic history, one where the terrifying crash of foreign confidence in U.S. debt forced a generational recalibration of fiscal, monetary, and social priorities, ultimately yielding a more resilient but markedly different American economy. The intervention, which peaked in scale during the late 2020s before gradual tapering in the 2030s, succeeded in preventing a catastrophic debt spiral, with long-term yields stabilizing in a 4 to 5% range that became the benchmark for borrowing across public and private sectors. The dollar, having undergone a managed depreciation of approximately 25% against major currencies by 2040, settles into a mature role as the leading but no longer overwhelmingly dominant reserve asset, sharing the global stage with a diversified basket that includes the yuan, euro, and digital alternatives. This new equilibrium born from crisis reflects not decline but adaptation, a United States that finances its ambitions through higher domestic savings, disciplined spending, and innovation-driven growth rather than unlimited foreign lending. Step by step, this matured economic model manifests in structural changes that touch every facet of American life, from household budgets to national strategy. Fiscal policy, reformed through bipartisan compromises in the 2030s, institutionalizes balanced budget rules for non-emergency spending, with automatic stabilizers for recessions and dedicated funds for strategic investments in technology and infrastructure. Ray. Venue sources diversify. Progressive wealth taxation and carbon pricing generate stable streams, while entitlement systems achieve solvency through indexed retirement ages and hybrid public-private models. Monetary policy evolves toward constrained independence. The Fed maintains dual mandates, but with enhanced congressional oversight on balance sheet size, preventing unchecked expansion while preserving operational flexibility. Less discussed in historical accounts of this era is the subtle cultural renaissance that fiscal discipline and higher yields foster, a renaissance rooted in renewed emphasis on tangible value creation over financial engineering. Entrepreneurship shifts toward patient capital. Venture funding favors deep tech and physical innovation, fusion energy commercialization by 2045, advanced biotechnology extending healthy lifespans rather than short-term digital disruptions. Artistic and intellectual pursuits flourish in an environment of moderated speculation. Literature explores themes of resilience and intergenerational stewardship, while philosophy re-examines prosperity beyond material accumulation. Education systems, fully digitized and personalized by quantum-assisted learning platforms, produce cohorts skilled in systems thinking and ethical technology deployment, ensuring human agency in an automated world. Another enduring but understated legacy involves the geopolitical realignment that reduced foreign dependence on U.S. debt enables, allowing America to pursue a more focused and sustainable global role. Military posture emphasizes quality over quantity. Investments concentrate on space domain awareness, cyber quantum resilience, and allied interoperability, reducing overseas basing while enhancing rapid deployment capabilities. Diplomatic influence pivots towards soft power. Leadership in climate accords, pandemic preparedness, and space governance leverages technological advantages without overextension. Rivalries managed through mutual deterrence. Quantum and AI arms control treaties, negotiated in the 2040s, establish verification regimes that prevent destabilizing breakthroughs. By the 2050s, quantitative legacies affirm the intervention's net positive impact. Debt to GDP ratios decline below 80% through compounded growth and discipline, restoring fiscal space for future challenges like climate adaptation and space colonization. Inflation averages 2.5% over the period, enabling real wage gains across skill levels. Productivity compounds at 3% annually from technological adoption, lifting living standards equitably as automation complements rather than displaces labor under reformed social contracts. Social cohesion strengthens through shared purpose. Universal basic services, healthcare, education, digital connectivity become entrenched, funded by sustainable revenues. Regional revitalization succeeds. Former manufacturing zones thrive on green industry clusters, while urban centers lead in creative economies. Intergenerational equity achieves balance. Youth inherit manageable debt and abundant opportunity. Elders benefit from secure retirements. Global implications mature into cooperative multipolarity. De-dollarization plateaus as alternatives prove complementary rather than replacement, with basket reserves reducing volatility. Trade flows diversify, supply chains resilient through redundancy. Innovation democratizes. Open-source quantum frameworks and international research consortia accelerate solutions for shared threats, asteroid deflection, pandemic eradication, ocean restoration. In the ultimate historical contemplation, the 2025 auction failure and Fed's terrifying intervention stand as humanity's great fiscal catharsis, a crisis that exposed excesses of debt-fueled growth but catalyzed renewal through constraint. Japan's and China's refusal to buy bonds, pragmatic in context, inadvertently gifted the world a more balanced order, dispersing financial power and encouraging responsibility. This era illuminates eternal verities. Prosperity demands alignment of means with ends, crises forge character when met with resolve, and true strength lies in adaptation that serves collective good. As higher yields and disciplined borrowing become normalized, the legacy affirms wisdom gained. An America renewed in purpose, a world financially mature, humanity advancing through prudent stewardship of resources finite and infinite. In this rebalanced prosperity lies enduring hope, for generations inheriting not burdens but possibilities, where economic tools serve dreams rather than defer them.